Welcome from ADK Wealth Advisory Group in St. Louis. As many of you know, I'm Dan Davis. I'm joined today with one of my colleagues, Rich Kurowski, Certified Financial Planner. Our focus today is going to be on bubbles and Medicare and our concerns about Medicare in the intermediate term. In our last market update, I talked about our focus would be on China. But as I've been listening and reading many different media sources, as well as having conversations with clients, these two topics seem to be something that would be most pressing to discuss today. A good starting place in a conversation about financial market bubbles is a definition. If you go to Wikipedia or Investopedia, both of them have a very similar definition, and I'll read Wikipedia's. A stock market bubble is a type of economic bubble taking place in stock markets when market participants drive stock prices above their value in relation to some system of valuations. Investopedia has the same theme, and the essence of it is that there's supposedly this reasonable price of stocks or real estate or any variable asset. And then if the price, the going price, is significantly above that reasonable price, that's when you have what we call as an excessive premium. And that is where you really have the essence of a bubble. Now, we've had two financial bubbles in a very short period of time. When you go back to 2000 through 2002, and 2007 and 2008, the catalyst of those was radically different. But the reality of what happened was that things like stocks and things like real estate went to excessive valuations. And it's my experience from observing human behavior with our clients and with my friends that after you have something like that happen a couple times, you start to become weary, even fearful of when will the next shoe drop. And as a result of that, I think many times when you see news of stock market highs or that real estate is rebounding, it starts to make one wonder, are we in another bubble? So a couple good checkpoints when we talk about valuations. One is what's a historical value? When you take a look at stocks, they use PEs. Real estate, commercial-wise, they use a thing called a cap rate. And for residential real estate, they use this concept of what's the median price, and they compare it to median income. And at this particular point, when I do that, there is no apparent bubble in the developed world that I see. U.S. stock market, the S&P 500, historical PE average is about 15.5. And that dates back into the 1800s. If you take a look at a trailing 12-month PE, it's 17.4. So clearly that's a premium. We've never seen a market crash with PEs in the 17 or below. Now, that doesn't mean that this couldn't be a first. It just means historically we've never seen it. And to put it in perspective, when the stock market crashed in 2000, PEs were above 30. If you do a forward PE where you're looking at forecasted corporate earnings and current prices, we're at 15.2. So a real big issue this coming period of announcement for earnings is do the companies actually continue to grow their earnings, and what are valuations? Schiller is a professor who's world renowned for his Case-Shiller real estate evaluation, where he takes a look at what's going on with residential real estate, and he looks at all the different major markets throughout the United States. He also has a unique way of looking at valuations for stocks, where he does a 10-year PE average, and then he factors in inflation. He's the only one that I'm reading right now that has concerns about valuations in the equity markets. A book that I've recently finished by Charles Kinderberger called Manias, Panics, and Crashes is pretty interesting in how he's gone back over the last 400 years, and he's gone through historically and really evaluated what's caused bubbles that's led to crashes. And I think it's really important to discern the difference between normal volatility and bubbles. Because a normal volatility, to see a market pull back 10 to 20% is not a crash. That's a correction as long as it's going up, comes down, and then continues to go back up. A crash is when it's going up and goes to levels it shouldn't go to, and then plummets down and you see it go down somewhere between a third and half of its value. A key element of that is the mania period. During the mania period, what you'll see is valuations exceed what they should in normal historic terms. And a key driver to that is, first off, is something good's happening. Then credit is added so that people end up buying this good thing and driving it to levels that it should not go to. At some particular point, that excessive credit is really driving things more than any other variable, and it really is fueled by greed, people wanting to get rich. And the net effect of it is that when it gets to its pinnacle, there's an unsustainable path, and so then some kind of a prick happens on this bubble, it pops, and then you have the cascade coming down, thus the word crashes. In looking at the last 400 years worth of this, a major component is always excessive credit. And it's that excessive credit that I don't see at this particular point, along with valuations. And here's what I mean by that, is in the private sector there's this concept called a money multiplier. So if the banks have money, they lend it out. When they lend it out, a person actually takes the money and spends it. When they spend it, that person who's made money from that brings in the money and they spend it. So you get this trickle throughout the economy. The net effect of that is that you see rising inflation because wages go up and price values of many things go up. And so in our current setting, I see pieces of that, like prices going up on stocks, but I don't see excessive valuations, I don't see inflation, and I certainly don't see this excessive money multiplier happening with the banks. As a matter of fact, banks are loaning money again, but still at a very, very slow rate compared to what they were. So if I were really going to kind of summarize things, I would say that because of the last couple of bubbles that we've seen, I think people are very, very concerned of the shoe that's going to drop potentially in the future. But at this particular point in the developed world, I actually do not think that we have a bubble in the making. Now, if you leave the private sector and go into the public sector and governments, that's where I have concerns, because they're building debt that is very, very excessive. And you'll see countries that, in theory, are supposed to have debt to GDP at 80% or below. But right now, I would say the majority of the developed world countries have debt that exceeds that level. It's not driving up prices. It's not positioning it to where we're seeing excessive valuations in residential, commercial markets, nor are we seeing it in stock markets. We are seeing close to all-time highs, but that doesn't mean all-time highs do not mean excessive valuations. We're going to spend some time now with Rich on our concerns around the public sector because of our concerns with the U.S. government's inability to meet their obligations, specifically around Medicare. With that, I'll turn it over to Rich.
Thanks, Dan. We feel that growth in the U.S. economy will continue at its current pace in the near term, and the potential for growth is even greater in the longer term, primarily due to the energy and food production sectors. As Dan said, it's those intermediate term years, the next 5 to 7 years, that we're concerned about. The primary reason for this is growing federal budget deficits, primarily due to the increased cost of Social Security and Medicare, and especially Medicare. Now, two things are happening with Medicare. First, the number of enrollees will double in the next 20 years. And second, the cost per enrollee will also double during this period. Today we have 50 million Medicare recipients. There will be 90 to 100 million Medicare recipients by 2035 in the peak enrollment years. Today costs are approximately $12,000 per enrollee. They'll be $22,000 or more in 2035. Now, there's two federal trust funds associated with the Medicare system. Both rely mostly on dedicated sources of tax and premiums for revenue to cover cost. These Medicare trust funds already are running negative cash flows and have been since 2007. And the reserves in these funds are going to run out in 2026. Once these reserves are used up, we'll be forced to cut benefits. Now, money to cover costs over and above these dedicated revenue sources can only come from the federal government General Revenue Fund. What is an even bigger concern is the drastic effect Medicare deficits are going to have on the overall federal budget deficit before 26. Within the next 5 to 7 years, half the Medicare budget will come from general revenue deficit spending over and above the current level of deficit spending of about $500 to $600 billion a year. To provide perspective, if the federal budget remains at the current 20% of GDP, within 5 years, the major benefit programs will make up 60% of the federal budget. By 2035, at the peak enrollment years of Social Security and Medicare, these programs will make up 80% of the federal budget. Now, when you include interest on the deficits, there will be little left in the budget for defense or any type of discretionary spending. So in summary, all this is not sustainable, and we're going to start feeling the effects of this soon, starting within the next 5 years or so. This is where our concern for the intermediate term comes from, and our hope is that we'll begin to see solutions coming, and they'll be coming soon.
So there's kind of two levels of conclusion. Conclusion one is about the video market update. Conclusion two is more broad stroking and what our market outlook is, if you will. So level one is, I do not see in the developed world any bubbles that are around financial assets. It doesn't mean that we couldn't build those bubbles over the near future if valuations get excessive. We'll be monitoring that to pay attention. We do have a lot of concern about the emerging markets, which we'll deal with in an upcoming video. We do have a lot of concerns with government debt. For example, Rich just went into our real concerns about Medicare. And it's my personal opinion, I don't like this opinion, but it's my personal opinion that we're at a stage with that government program that raising taxes and cutting benefits are a must. They cannot raise taxes enough to solve the problem, and they're going to have to cut benefits a lot. Now, I personally don't think that those benefits are going to get cut proactively. I think it's going to be reactive when we're in a crisis mode, and that's why our level 2 summary or conclusion is really, in the near term, say the next 18 months, we think just normal volatility exists with reward for the risk. Our real concern is when you look at that intermediate term period, that 2016 to 2020, it's hard for me to imagine whether we hit a bubble or whether we just hit some kind of a major financial debt problem that has a crisis associated with it. It's hard for me to imagine getting out of that window without some kind of a major financial problem. But then when we look long term, 2020 and beyond kind of stuff, we are very optimistic because of trends that we've talked about in past videos with energy, as well as with the doubling of the middle class in places like Asia and Latin America. So wanted to just say thank you very much for taking your time to enjoy the video with Rich and myself. Would also like to ask you to share it with your friends and your family. If you've received this via social media, send it along. If you've received it via email, forward it to someone that you care about. It's a way that we think that many people who have concerns about bubbles and concerns about Medicare, that we can share some wisdom with them and help them out. If you're a potential client watching this, please go to Discover Independence to learn more about us, and if you'd like to chat, reach out to us in the contact information. Again, thank you very much and have a great rest of the summer. Bye-bye.